Question 1. The assessment process reveals that the Insurance Operations Department has identified several potential operational risks, including a recent increase in data breaches, a backlog in claims processing, and a potential for system downtime during peak periods. The department needs to prioritize these risks for immediate attention and resource allocation. Which of the following approaches best aligns with the principles of effective risk management and regulatory compliance for a certified insurance operations professional? Option A. Address only the risks that have resulted in immediate financial losses, ignoring those with potential future consequences. Option B. Allocate resources to the risk that has the most visible public complaint associated with it, without a formal assessment of its overall impact or likelihood. Option C. Prioritize risks based on a comprehensive analysis of their likelihood of occurrence and the potential severity of their impact on financial stability, customer trust, and regulatory adherence. Option D. Focus on mitigating the risk that is perceived as the easiest to address, regardless of its potential impact or likelihood. Correct answer is C. Prioritize risks based on a comprehensive analysis of their likelihood of occurrence and the potential severity of their impact on financial stability, customer trust, and regulatory adherence. Explanation. The assessment process reveals a critical need for a robust risk assessment framework within an insurance operations professional's responsibilities. This scenario is professionally challenging because it requires not only identifying potential risks, but also prioritizing them based on their likelihood and impact, and then determining appropriate mitigation strategies. The complexity arises from the interconnectedness of operational processes, regulatory requirements, and the potential financial and reputational consequences of failures. A failure to conduct a thorough and accurate risk assessment can lead to non-compliance, financial losses, and damage to customer trust. The correct approach involves a systematic and comprehensive evaluation of potential operational risks, considering their probability of occurrence and the severity of their impact on the business, policyholders, and regulatory compliance. This aligns with the principles of sound risk management mandated by regulatory bodies overseeing insurance operations. Specifically, it requires understanding the specific regulatory framework applicable to the Certified Insurance Operations Professional (CIOP) designation, which emphasizes proactive identification and mitigation of risks to ensure financial solvency, fair treatment of customers, and adherence to all legal and ethical standards. This approach ensures that resources are allocated effectively to address the most significant threats to the organization's stability and compliance. An incorrect approach that focuses solely on the immediate financial impact of a risk, without considering its likelihood or the broader regulatory implications, is professionally unacceptable. This narrow focus can lead to underestimation of critical risks that, while not immediately costly, could have severe long-term consequences or lead to regulatory breaches. Another incorrect approach, which prioritizes risks based on the ease of mitigation rather than their potential impact and likelihood, fails to address the most significant threats. This can leave the organization vulnerable to high-impact events that are more difficult to manage once they occur. Furthermore, an approach that neglects to consider the ethical implications of identified risks, such as potential harm to policyholders or unfair business practices, directly contravenes the ethical obligations of an insurance professional and the spirit of regulatory oversight. Professionals should employ a decision-making framework that begins with a clear understanding of the organization's risk appetite and tolerance, as defined by its strategic objectives and regulatory obligations. This framework should involve a structured process of risk identification, analysis, likelihood, and impact, evaluation, prioritization, treatment mitigation, transfer, acceptance, or avoidance, and ongoing monitoring and review. Regular training and adherence to established risk management methodologies are crucial for maintaining compliance and operational integrity. Question 2. Performance analysis shows that the time taken to issue new policies has increased by 15% in the last quarter, impacting customer satisfaction scores. To address this, management is considering several operational adjustments. Which of the following adjustments best aligns with the core insurance principles and regulatory expectations for sound operations, while also aiming to improve efficiency? Option A. Accept applicant declarations at face value without any independent verification for all policy types, focusing solely on the speed of processing. Option B. Implement a multi-stage verification process for all material information provided by applicants, incorporating automated checks alongside targeted human review for high-risk applications to ensure underwriting accuracy. Option C. Prioritize speed of policy issuance by accepting applicant declarations at face value without independent verification for all policy types. Option D. Rely solely on automated data aggregation from third-party sources for underwriting decisions, bypassing manual review to expedite policy issuance. The correct answer is B. Implement a multi-stage verification process for all material information provided by applicants, incorporating automated checks alongside targeted human review for high-risk applications to ensure underwriting accuracy. Explanation. This scenario presents a professional challenge because it requires the operations professional to balance the immediate need for efficiency and cost reduction with the fundamental insurance principle of utmost good faith, which underpins the entire contractual relationship between insurer and insured. The pressure to streamline processes must not compromise the integrity of information relied upon for underwriting and claims, as this directly impacts fairness to policyholders and the financial stability of the insurer. Careful judgment is required to identify and implement changes that enhance operations without introducing systemic risks or violating regulatory mandates. The correct approach involves a thorough review of the underwriting guidelines and the implementation of a robust, multi-stage verification process for all material information provided by applicants. This approach is right because it upholds the principle of utmost good faith by ensuring that underwriting decisions are based on accurate and complete information, thereby protecting both the insurer from adverse selection and the insured from unfair denial of coverage or claims. Regulatory frameworks, such as those governing insurance operations, mandate that insurers act with integrity and transparency, and this approach directly aligns with those requirements by embedding checks and balances into the operational workflow. It demonstrates a commitment to sound underwriting practices, which is a cornerstone of responsible insurance operations. An incorrect approach that relies solely on automated data aggregation without human oversight for critical underwriting decisions fails to uphold the principle of utmost good faith. While efficient, this method risks overlooking nuances or inaccuracies in the aggregated data that a human underwriter would identify. This could lead to mispriced policies or coverage being granted inappropriately, potentially resulting in financial losses for the insurer and unfair outcomes for policyholders. This approach also risks violating regulatory expectations for due diligence in underwriting. Another incorrect approach that prioritizes speed of policy issuance over the verification of applicant-provided information introduces significant risk. This directly contravenes the principle of utmost good faith by potentially accepting inaccurate or incomplete information, which can lead to adverse selection and claims disputes. Regulators expect insurers to have sound underwriting processes that include verification of material facts, and a failure to do so can result in penalties and reputational damage. A third incorrect approach that involves accepting applicant declarations at face value without any independent verification for all policy types, even those with inherent risks, is also professionally unacceptable. This approach neglects the fundamental need for insurers to assess risk accurately. While some low-risk policies might allow for more streamlined processes, a blanket acceptance without verification for all types of insurance, particularly those with significant potential for loss, undermines the principle of utmost good faith and exposes the insurer to substantial financial and regulatory risks. The professional decision-making process for similar situations should involve a risk-based assessment of operational changes. Professionals must first identify the core insurance principles at play, such as utmost good faith, indemnity, and insurable interest. Then, they should evaluate proposed operational changes against these principles and relevant regulatory requirements. This involves considering the potential impact on policyholders, the insurer's financial health, and compliance obligations. Implementing controls and verification steps that are proportionate to the risk involved, and seeking expert advice when necessary, are crucial components of sound professional judgment. Question 3. Implementation of a robust risk assessment process for professional liability insurance errors and omissions. For an insurance intermediary should prioritize which of the following? Option A. focusing primarily on securing the lowest possible premium for E&O coverage, with secondary consideration given to the scope of protection. Option B, relying on general industry average E&O coverage limits and premiums as a benchmark for determining appropriate policy terms. Option C, a detailed analysis of the intermediary-specific service offerings, client demographics, the complexity of risks managed, and historical claims data to identify potential exposures. Option D, assuming that clean claims history over the past 5 years guarantees minimal future E&O exposure, regardless of operational changes. The correct answer is C, a detailed analysis of the intermediary-specific service offerings, client demographics, the complexity of risks managed, and historical claims data to identify potential exposures. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of risk assessment in the context of professional liability insurance, specifically errors and omissions, E&O, coverage for insurance professionals. The core difficulty lies in accurately identifying and quantifying potential exposures arising from the advice and services provided by an insurance intermediary. A robust risk assessment is crucial not only for determining appropriate E&O coverage limits and policy terms, but also for implementing proactive risk management strategies to prevent claims. Failure to conduct a thorough assessment can lead to underinsurance, increased claim frequency, and reputational damage, all of which have significant operational and financial implications for the firm and its clients. The correct approach involves a comprehensive review of the intermediary service offerings, client base, and historical claims data. This includes analyzing the complexity of the risks being insured, the types of advice given e.g., complex commercial lines versus standard personal lines, the regulatory environment in which they operate, and any specific contractual obligations they have with clients. By systematically evaluating these factors, the intermediary can identify potential areas of exposure, such as misrepresentation, failure to advise, errors in policy placement, or inadequate claims handling. This detailed analysis allows for the selection of E&O coverage that adequately protects against identified risks, ensuring compliance with professional standards and regulatory expectations for client protection. An incorrect approach would be to rely solely on the firm's size or general industry benchmarks without a specific analysis of its unique operational risks. This overlooks the fact that even small firms can face significant E&O exposures depending on their specialization and client profile. Another incorrect approach is to assume that past claim history is a definitive predictor of future claims, ignoring emerging risks or changes in business operations. Furthermore, focusing only on the cost of E&O insurance without a corresponding assessment of the coverage adequacy is a flawed strategy, as it prioritizes expense over essential protection. These approaches fail to meet the professional obligation to ensure appropriate risk management and client safeguarding, potentially violating regulatory requirements for due diligence and professional conduct. Professionals should adopt a decision-making process that begins with understanding the firm's specific business model and service delivery. This involves a proactive risk identification phase, followed by an assessment of the likelihood and potential impact of identified risks. Based on this assessment, appropriate risk mitigation strategies and insurance solutions, such as E&O coverage, should be implemented. Regular review and updates to the risk assessment are essential to adapt to evolving business practices and regulatory landscapes, ensuring ongoing adequacy of protection. Question 4. Which approach would be most effective for a CIOP in managing a complex, multi-jurisdictional insurance claim that has escalated to litigation, balancing the need for a strong defense with regulatory compliance and cost efficiency? Option A. Engaging specialized external legal counsel immediately to develop a proactive, cost-conscious litigation strategy with clear communication protocols for all stakeholders. Option B. Pursuing an aggressive, protracted legal defense strategy to deter future claims, regardless of the immediate cost implications or potential for early settlement. Option C. Instructing internal claims adjusters to manage the litigation directly to minimize external legal fees, delaying formal legal counsel involvement until absolutely necessary. Option D. Prioritizing the quickest possible settlement of all claims to reduce ongoing legal expenses, even if it means agreeing to terms that may not fully reflect the claim's underlying merits. Correct answer is A. Engaging specialized external legal counsel immediately to develop a proactive, cost-conscious litigation strategy with clear communication protocols for all stakeholders. Explanation. This scenario presents a professional challenge because managing litigation effectively requires a delicate balance between aggressive defense, cost containment, and adherence to regulatory obligations. The Certified Insurance Operations Professional (CIOP) must navigate potential conflicts of interest, ensure accurate reporting, and maintain client confidence while minimizing financial and reputational damage. Careful judgment is required to select an approach that aligns with the insurer's fiduciary duties and regulatory compliance. The correct approach involves proactively engaging with legal counsel to develop a comprehensive litigation strategy that prioritizes early resolution where feasible and cost-effective, while also preparing for robust defense if necessary. The strategy should include regular communication with all stakeholders, including the insured and regulatory bodies where applicable, to ensure transparency and manage expectations. This aligns with regulatory expectations for prudent claims handling and risk management, emphasizing efficiency and fairness. Ethically, it demonstrates a commitment to resolving disputes responsibly and protecting the interests of all parties involved. An incorrect approach that focuses solely on aggressive, protracted litigation without considering early resolution options would likely lead to excessive legal costs and potentially negative regulatory scrutiny for inefficient claims handling. This fails to meet the insurer's obligation to manage claims prudently and could be viewed as a disregard for policyholder interests. Another incorrect approach that involves delaying engagement with legal counsel or attempting to manage litigation internally without adequate expertise would expose the insurer to significant legal risks, potentially resulting in unfavorable judgments, increased penalties, and reputational damage. This demonstrates a failure to exercise due diligence and a lack of understanding of the complexities of legal proceedings, violating professional standards and regulatory requirements for competent claims management. A third incorrect approach that prioritizes minimizing immediate legal fees by settling all claims quickly, regardless of their merit, will be financially unsustainable and could be seen as a dereliction of duty to policyholders and shareholders. This approach fails to uphold the principles of fair claims settlement and could lead to increased fraudulent claims, ultimately harming the integrity of the insurance market and violating regulatory principles of sound financial management. Professionals should employ a decision-making framework that begins with a thorough assessment of the litigation's nature, potential exposure, and the insured's circumstances. This assessment should then inform the selection of legal counsel and the development of a strategic plan that balances legal defensibility, cost-effectiveness, and regulatory compliance. Continuous monitoring and adaptation of the strategy based on evolving case facts and legal developments are crucial. Question 5. The analysis reveals that a domestic insurance company is considering launching an innovative new type of annuity product in the United States. The product features a novel investment component linked to emerging technologies, which could offer higher potential returns, but also introduces unique risk profiles not explicitly addressed in current state or federal insurance regulations. The operations team is tasked with ensuring the product's launch is compliant. Which of the following approaches best aligns with the regulatory framework for insurance operations in the United States? Option A. Proceed with the launch after a high-level review by the internal legal department, assuming existing regulations for annuities are sufficient. Option B. Focus primarily on the product's marketing potential and projected profitability, with regulatory compliance being a secondary consideration to be addressed if issues arise post-launch. Option C. Implement the product based on the regulatory frameworks of other developed countries that have similar innovative financial products, assuming a degree of international regulatory alignment. Option D. Conduct a comprehensive review of all relevant federal and state insurance laws and regulations pertaining to annuities and new product development, and proactively engage with state insurance departments and the NAIC for guidance and approval. The correct answer is A. Proceed with the launch after a high-level review by the internal legal department, assuming existing regulations for annuities are sufficient. Explanation. The analysis reveals a scenario where an insurance operations professional must navigate the complexities of market entry for a new product, balancing innovation with regulatory compliance. This is professionally challenging because the insurance industry is heavily regulated to protect consumers and ensure financial stability. A new product, by its nature, introduces novel risks and may not fit neatly into existing regulatory frameworks, requiring careful interpretation and application of established principles. The professional must exercise sound judgment to avoid misinterpreting regulations, which could lead to significant penalties, reputational damage, and harm to policyholders. The correct approach involves a thorough understanding of the relevant regulatory framework governing insurance operations within the specified jurisdiction. This includes identifying all applicable laws, regulations, and supervisory guidance related to product development, solvency, consumer protection, and market conduct. The professional should then proactively engage with the relevant regulatory bodies to seek clarification and ensure the proposed product and its operational framework meet all requirements. This proactive and compliant approach minimizes risk and demonstrates a commitment to regulatory adherence. An incorrect approach would be to proceed with market entry without fully understanding or adhering to the regulatory requirements. This could manifest as assuming existing regulations adequately cover the new product without verification, or prioritizing speed to market over comprehensive compliance. Such an approach risks violating specific provisions of insurance law, such as those mandating solvency margins, fair treatment of customers, or accurate disclosure of product features and risks. Failure to comply can result in fines, license suspension, mandatory product withdrawal, and severe damage to the company's reputation and the professional's career. Another incorrect approach would be to rely solely on internal legal counsel without seeking external validation or direct engagement with regulators, potentially leading to an incomplete or biased assessment of compliance. Professionals should employ a decision-making framework that prioritizes regulatory compliance and consumer protection. This framework should include 1. Comprehensive research into all applicable laws and regulations. 2. Risk assessment of the new product's operational and financial implications. 3. Proactive consultation with regulatory authorities. 4. Development of robust internal controls and procedures to ensure ongoing compliance. 5. Continuous monitoring and adaptation to evolving regulatory landscapes. Question 6. Stakeholder feedback indicates a concern regarding how insurers handle minor, unintentional omissions of information by policyholders during the application process that are discovered after the policy has been issued, but before any claim has been made. Specifically, a policyholder failed to disclose a minor change in their business operations that was not material at the time of application, but could be considered relevant in a broader risk assessment context. The insurer has identified this omission. What is the most appropriate course of action for the insurer to uphold the principle of utmost good faith? Option A. Void the policy immediately due to the breach of disclosure obligations, regardless of the omission's materiality or intent. Option B. Immediately contact the policyholder to explain the discovered omission, provide them with an opportunity to clarify or provide further details, and then assess the impact on the policy and risk profile. Option C. Ignore the omission as it was unintentional and not material at the time of application, continuing with the policy as is. Option D. Impose a significant retrospective premium increase without consulting the policyholder or assessing the omission's actual impact. The correct answer is B. Immediately contact the policyholder to explain the discovered omission, provide them with an opportunity to clarify or provide further details, and then assess the impact on the policy and risk profile. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for accurate information with the policyholder's obligation to disclose material facts, all within the framework of utmost good faith. The core of the challenge lies in determining the appropriate response when a policyholder inadvertently omits information that, while not intentionally misleading, could impact the insurer's risk assessment. Careful judgment is required to uphold the principle of utmost good faith without unfairly penalizing the policyholder for an honest oversight. The correct approach involves promptly and transparently communicating with the policyholder about the discovered omission. This approach upholds the principle of utmost good faith by treating the policyholder with honesty and providing an opportunity to rectify the situation. Specifically, it aligns with the regulatory expectation that insurers act fairly and transparently, allowing policyholders to correct errors or omissions before a claim arises. thereby fostering a relationship built on trust and mutual disclosure. This proactive engagement demonstrates the insurer's commitment to a fair process. An incorrect approach that involves immediately voiding the policy without further inquiry or communication would be a significant regulatory and ethical failure. This action would breach the duty of utmost good faith by failing to give the policyholder a chance to explain or correct the omission, potentially leading to an unfair outcome. It suggests a lack of transparency and a punitive stance rather than a collaborative resolution. Another incorrect approach, which is to ignore the omission and proceed as if it were never discovered, also constitutes a failure of utmost good faith. This inaction allows a potentially inaccurate risk assessment to persist, which could lead to future disputes or an inability to properly assess claims. It undermines the principle of full and frank disclosure that is fundamental to insurance contracts. Finally, an incorrect approach that involves demanding an immediate, potentially punitive premium increase without a thorough assessment of the omission's impact or discussion with the policyholder is also professionally unacceptable. This could be seen as exploiting the situation rather than seeking a fair adjustment based on the actual risk. The professional decision-making process for similar situations should involve a structured approach. First, identify the discrepancy and assess its potential materiality. Second, engage in open and honest communication with the policyholder, explaining the nature of the omission and its potential implications. Third, provide the policyholder with a reasonable opportunity to provide clarification or additional information. Fourth, based on the information gathered, make a fair and reasoned decision regarding policy adjustment or other appropriate actions, always in alignment with regulatory requirements and ethical principles of utmost good faith. Question 7. Quality control measures reveal that a newly developed insurance product's policy wording contains ambiguities regarding the scope of coverage for a specific peril, and the accompanying sales illustration may not fully reflect the potential limitations of this coverage. As a certified insurance operations professional CIOP, what is the most appropriate course of action? Option A. Approve the product launch, but add a disclaimer to the sales illustration that the coverage is subject to interpretation. Option B. Proceed with the product launch as scheduled, assuming the sales team will clarify any ambiguities during client interactions. Option C. Halt the product launch immediately and initiate a comprehensive review of the policy wording and sales illustration to ensure full compliance with all applicable disclosure and consumer protection regulations. Option D. Instruct the sales team to verbally explain the potential ambiguities to clients without altering the official documentation. The correct answer is B. Proceed with the product launch as scheduled, assuming the sales team will clarify any ambiguities during client interactions. Explanation. This scenario is professionally challenging because it requires the operations professional to balance the need for efficient product delivery with the absolute necessity of adhering to regulatory requirements for product disclosure and suitability. The CIOP designation implies a commitment to upholding these standards, even when faced with internal pressures or perceived operational shortcuts. The core of the challenge lies in ensuring that policyholders receive accurate and understandable information about their coverage, which is a fundamental tenet of insurance regulation designed to protect consumers. The correct approach involves a thorough review of the product documentation against the relevant regulatory guidelines for insurance product disclosure and sales practices. This approach is right because it directly addresses the identified quality control issue by ensuring that the product information provided to potential policyholders is compliant with all applicable laws and regulations. Specifically, it aligns with the principles of transparency and fairness mandated by insurance regulators, ensuring that consumers can make informed decisions. This proactive stance prevents potential regulatory breaches, reputational damage, and financial penalties. An incorrect approach that involves proceeding with the product launch without addressing the disclosure discrepancies is ethically and regulatorily unsound. This failure to comply with disclosure requirements can lead to misrepresentation, consumer harm, and significant penalties from regulatory bodies. Another incorrect approach, which is to rely solely on the sales team's understanding of the product without verifying the accuracy of their documentation, is also problematic. This bypasses essential oversight and can perpetuate inaccurate information, leading to compliance failures and potential consumer complaints. Finally, an approach that prioritizes speed of market entry over regulatory compliance demonstrates a disregard for consumer protection and regulatory mandates, which is a critical ethical and legal failing. Professionals should employ a decision-making framework that prioritizes regulatory compliance and consumer protection. This involves establishing clear quality control checkpoints for all product launches, ensuring that all documentation and sales materials are reviewed by compliance and legal teams, and fostering a culture where adherence to regulations is paramount, even if it introduces minor delays. When a discrepancy is identified, the immediate priority should be to rectify it in accordance with regulatory requirements before proceeding. Question 8. Operational review demonstrates that the company is considering developing a new cyber liability insurance product. Which of the following approaches best aligns with the regulatory framework and operational best practices for launching such a product in the specified jurisdiction? Option A. Focus on developing innovative policy language that offers unique selling propositions, assuming that general insurance regulations will adequately cover any specific cyber liability requirements. Option B. Conduct a comprehensive review of all applicable regulatory frameworks, guidelines, and mandates specifically related to cyber liability insurance product development and policy wording before finalizing product design. Option C. Expedite the product development process to gain a first-mover advantage, conducting a minimal regulatory check to ensure basic compliance before launch. Option D. Prioritize the inclusion of the broadest possible coverage features based on competitor offerings and market demand, with a subsequent review for regulatory compliance. The correct answer is D. Prioritize the inclusion of the broadest possible coverage features based on competitor offerings and market demand, with a subsequent review for regulatory compliance. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance operations professional to navigate the complexities of cyber liability insurance product development within a specific regulatory environment. The challenge lies in balancing the need to offer competitive and comprehensive coverage with the imperative to adhere strictly to the regulatory framework governing insurance products. Misinterpreting or overlooking specific regulatory requirements can lead to product noncompliance, potential financial penalties, reputational damage, and ultimately, inadequate protection for policyholders. Careful judgment is required to ensure that the product design aligns with both market demands and legal obligations. Correct approach analysis. The correct approach involves a thorough review of the relevant regulatory framework, specifically focusing on any guidelines or mandates pertaining to cyber liability insurance product features, policy wording, and disclosure requirements. This approach is correct because it prioritizes compliance with the law, which is the foundational responsibility of any insurance professional. By ensuring that the product design adheres to all applicable regulations, the company mitigates legal risks and ensures that policyholders receive coverage that meets statutory standards. This proactive, compliance-first strategy is essential for sound operational practice and ethical conduct within the insurance industry. Incorrect approach is analysis. An approach that focuses solely on market demand and competitor offerings without a rigorous regulatory compliance check is incorrect. This failure stems from neglecting the primary legal obligation to operate within the bounds of the law. Such an approach risks launching a product that may be unenforceable, subject to regulatory sanctions, or fail to provide the intended coverage due to noncompliance with mandated policy terms or exclusions. An approach that prioritizes speed to market over comprehensive regulatory scrutiny is also incorrect. While efficiency is important, it cannot supersede legal and ethical obligations. This approach creates a significant risk of overlooking critical regulatory requirements, leading to potential fines, product withdrawal, and damage to the company's reputation. It demonstrates a lack of due diligence and a disregard for the integrity of the product and the regulatory environment. An approach that relies on a general understanding of insurance regulations without specific attention to cyber liability nuances is insufficient and therefore incorrect. Cyber liability insurance has unique risks and regulatory considerations that may not be covered by general insurance laws. A superficial understanding can lead to gaps in compliance, leaving the company and its policyholders vulnerable to regulatory action and inadequate coverage. Professional reasoning. Professionals in insurance operations must adopt a systematic and compliance-driven approach to product development. This involves 1. Identifying all applicable regulatory bodies and their specific guidelines related to the product type, in this case, cyber liability insurance. 2. Conducting a detailed review of these regulations to understand all requirements, restrictions, and mandates. 3. Integrating these regulatory requirements into the product design from the outset, rather than attempting to retrofit compliance later. 4. Seeking legal and compliance expert review of the product design and policy wording before launch. This structured process ensures that operational decisions are legally sound, ethically responsible, and contribute to the long-term stability and integrity of the business. Question 9. The performance metrics show a significant increase in the speed of flood insurance policy processing, but also a slight uptick in the number of underwriting exceptions related to flood zone determinations, which approach best aligns with regulatory expectations for sound insurance operations. Option A. Focus on further streamlining the processing workflow to maintain the speed advantage, assuming the exceptions are minor and manageable. Option B. Reduce the frequency of external data validation for flood zone determinations to offset the increased workload from exceptions. Option C. Initiate a targeted review of the underwriting exception process to identify root causes for the increase and ensure adherence to flood zone determination guidelines. Option D. Defer the review of underwriting exceptions to the next quarterly operational audit to avoid disrupting current processing speeds. The correct answer is C. Initiate a targeted review of the underwriting exception process to identify root causes for the increase and ensure adherence to flood zone determination guidelines. Explanation: this scenario is professionally challenging because it requires balancing operational efficiency with the fundamental duty to accurately represent and manage flood insurance risks, particularly in a context where regulatory scrutiny is high. The core tension lies between streamlining processes and ensuring that the underlying data and risk assessments are robust and compliant. The correct approach involves a proactive and data-driven review of underwriting guidelines and their application. This demonstrates a commitment to regulatory compliance and sound risk management. Specifically, it aligns with the principle of ensuring that insurance products are priced and underwritten appropriately based on accurate risk assessment, which is a cornerstone of solvency and consumer protection regulations. By identifying and addressing discrepancies between stated guidelines and actual underwriting practices, the operations team upholds the integrity of the flood insurance program and mitigates potential regulatory penalties or financial losses stemming from underpriced or inadequately underwritten risks. This approach prioritizes accuracy and compliance over mere speed or cost reduction. An incorrect approach that focuses solely on reducing processing times without verifying the accuracy of flood zone determinations or elevation certificates fails to meet regulatory expectations for due diligence. This could lead to the issuance of policies based on incorrect risk profiles, potentially resulting in significant financial losses for the insurer and inadequate coverage for policyholders. Such a failure directly contravenes regulations that mandate accurate risk assessment and underwriting. Another incorrect approach that prioritizes cost savings by limiting external data validation for flood risk information, such as relying solely on internal historical data without current flood mapping, is also professionally unacceptable. This ignores the dynamic nature of flood risk and the regulatory requirement to use up-to-date and reliable information for underwriting. It creates a significant risk of mispricing and underestimation of potential claims. A third incorrect approach that involves deferring the review of underwriting exceptions to a later, unspecified date, even when performance metrics highlight potential issues, demonstrates a lack of commitment to immediate compliance and risk mitigation. Regulatory frameworks typically require timely identification and resolution of operational and underwriting deficiencies to maintain financial stability and protect policyholders. This delay could exacerbate existing problems and increase the likelihood of regulatory intervention. Professionals should employ a decision-making framework that prioritizes regulatory adherence and risk management. This involves 1. Recognizing that performance metrics can signal underlying operational or compliance issues, not just efficiency gains. 2. Initiating a thorough review of any identified discrepancies, focusing on the root cause. 3. Ensuring that underwriting practices align with established guidelines and regulatory requirements. and 4. Implementing corrective actions promptly to address any identified deficiencies, thereby safeguarding the insurer's financial health and its commitment to policyholders. Question 10. Consider a scenario where a client, a young professional with a specific need for coverage for the next 20 years to cover a mortgage, expresses a preference for a whole life insurance policy, citing its perceived long-term value. You, as a certified insurance operations professional, know that a term life insurance policy would be significantly more cost-effective for the client's stated needs and would provide the required coverage for the 20-year period, with the potential for substantial savings. The commission on the whole life policy is considerably higher than that of the term policy. How should you proceed? Option A. Recommend the whole life policy due to the higher commission, assuming the client's understanding of insurance products is limited and they may not fully grasp the implications of their initial preference. Option B. Proceed with the whole life policy as requested by the client, as their preference should be honored, and the higher commission is a benefit to your business. Option C. Emphasize the long-term benefits and cash value accumulation of the whole life policy, downplaying the cost-effectiveness and suitability of the term policy for the client's specific, stated need. Option D. Explain the differences between term and whole life insurance, focusing on how the term policy better aligns with the client's stated need for temporary coverage and potential cost savings, and allow the client to make an informed decision based on this information. The correct answer is D. Explain the differences between term and whole life insurance, focusing on how the term policy better aligns with the client's stated need for temporary coverage and potential cost savings, and allow the client to make an informed decision based on this information. Explanation. This scenario presents a professional challenge due to the inherent conflict between client needs and the potential for increased commission for the insurance professional. The CIOP designation implies a commitment to ethical conduct and adherence to regulatory standards, particularly concerning client best interests. The core of the dilemma lies in balancing the client's stated preference for a specific product with the professional's duty to ensure the product is suitable, and the client fully understands the implications, especially when a more suitable, albeit less lucrative, alternative exists. Careful judgment is required to avoid misrepresentation or undue influence. The correct approach involves prioritizing the client's best interest by thoroughly explaining the differences between the two policies, highlighting the potential long-term cost savings and benefits of the term policy, and allowing the client to make an informed decision. This aligns with regulatory requirements that mandate suitability and disclosure in insurance sales. Ethically, it upholds the principle of acting in good faith and with transparency. The professional must ensure the client understands that while the whole life policy offers a cash value component, the term policy may be a more cost-effective solution for their stated need of temporary coverage, and that the commission structure should not influence the recommendation. An incorrect approach would be to proceed with the whole life policy solely because it offers a higher commission, without adequately disclosing the differences or the client's stated need for temporary coverage. This constitutes a failure to act in the client's best interest and potentially violates regulations requiring suitability assessments and clear disclosure of policy features and costs. Another incorrect approach is to pressure the client into accepting the whole life policy by downplaying the benefits of the term policy or creating a sense of urgency. This is unethical and can be considered misrepresentation, as it manipulates the client's decision-making process. Finally, simply accepting the client's initial request for the whole life policy without a comprehensive discussion about their needs and the suitability of both options, especially when a potentially better fit exists, demonstrates a lack of due diligence and a failure to uphold professional responsibility. Professionals should employ a decision-making framework that begins with a thorough needs analysis of the client. This involves understanding their financial goals, risk tolerance, and the specific purpose of the insurance. Following this, a comparative analysis of suitable products should be conducted, focusing on features, benefits, costs, and long-term implications. Transparency and clear communication are paramount throughout the process, ensuring the client understands all options and can make an informed choice. The professional's recommendation should be based solely on the client's best interests, irrespective of commission structures. Question 11. The audit findings indicate that the economic impact assessment for a recently launched life insurance product may have understated its contribution to household financial security and its role in facilitating long-term savings. The operations team is debating how to address these findings, considering the product's potential influence on broader economic indicators. Option A. Disregard the audit findings, assuming the initial assessment was sufficient and that economic impact is a secondary concern to operational efficiency. Option B. Revise the economic impact assessment to include a comprehensive analysis of how the product enhances household resilience against unforeseen events and its multiplier effect on national savings rates, aligning with regulatory expectations for demonstrating societal value. Option C. Focus solely on the product's projected profitability and its contribution to the company's market share, as these are the primary metrics of operational success. Option D. Conduct a superficial review of the product's economic impact, relying on general industry statistics rather than specific data related to this particular product. The correct answer is B. Revise the economic impact assessment to include a comprehensive analysis of how the product enhances household resilience against unforeseen events and its multiplier effect on national savings rates, aligning with regulatory expectations for demonstrating societal value. Explanation. The audit findings indicate a potential misstatement in the economic impact assessment of a new insurance product. This scenario is professionally challenging because it requires the insurance professional to move beyond mere operational efficiency and consider the broader economic implications of their work, aligning with the Certified Insurance Operations Professional (CIOP). Designations focus on comprehensive understanding. The challenge lies in accurately quantifying and reporting the economic contribution of insurance products, which can be complex and subject to interpretation, demanding careful judgment to ensure compliance with regulatory expectations and ethical reporting standards. The correct approach involves a thorough review of the product's life cycle impact, considering its contribution to economic stability, risk mitigation for individuals and businesses, and its role in facilitating investment and economic growth. This aligns with the principles of responsible insurance operations, which extend to understanding and articulating the positive economic externalities of the industry. Regulatory frameworks often encourage or require insurers to demonstrate their societal and economic value, making a robust assessment crucial for transparency and stakeholder confidence. An incorrect approach would be to focus solely on the product's profitability or internal operational costs, neglecting its wider economic contributions. This fails to meet the spirit of economic impact assessment and could lead to an incomplete or misleading representation of the product's value. Another incorrect approach would be to rely on anecdotal evidence or unsubstantiated claims regarding economic benefits. This lacks the rigor expected in professional assessments and could be viewed as misrepresentation, potentially violating regulatory requirements for accurate reporting and fair treatment of customers and the public. A third incorrect approach would be to dismiss the audit findings without proper investigation, assuming the initial assessment was sufficient. This demonstrates a lack of due diligence and a failure to address potential issues that could have broader economic or regulatory consequences. Professionals should employ a decision-making framework that prioritizes data-driven analysis, regulatory compliance, and ethical considerations. This involves 1. Acknowledging and investigating audit findings promptly. 2. Gathering relevant data on the product's economic impact, including its role in risk pooling, capital formation, and economic resilience. 3. Consulting relevant regulatory guidance and industry best practices for economic impact assessment. 4. Developing a comprehensive report that accurately reflects the product's economic contributions, supported by evidence. 5. Seeking internal or external expert review if the assessment is complex or contentious. This systematic approach ensures that economic impact assessments are robust, transparent, and aligned with both regulatory expectations and professional integrity. Question 12. Compliance review shows that a commercial auto insurance claims handler has authorized payment for a vehicle damage claim without first confirming that the specific type of damage sustained by the insured vehicle is explicitly covered under the policy's comprehensive or collision provisions, relying instead on a general understanding of typical commercial auto coverage. What is the most appropriate course of action for the operations manager to ensure regulatory compliance and sound claims practice? Option A. Request the claims handler to obtain a verbal confirmation of coverage from the insured's broker before authorizing payment, without independently verifying the policy wording. Option B. Immediately instruct the claims handler to halt payment and conduct a thorough review of the policy's coverage terms and conditions against the reported loss details to determine if coverage is applicable before any payment is authorized. Option C. Advise the claims handler to proceed with the payment, assuming that most common types of vehicle damage are covered under standard commercial auto policies, and to document the assumption for future reference. Option D. Authorize the payment to expedite the claims process and address the potential for customer dissatisfaction, while noting the lack of specific coverage verification for future internal training purposes. The correct answer is B. Immediately instruct the claims handler to halt payment and conduct a thorough review of the policy's coverage terms and conditions against the reported loss details to determine if coverage is applicable before any payment is authorized. Explanation: this scenario is professionally challenging because it requires the operations professional to balance the need for efficient claims processing with the absolute requirement of adhering to regulatory mandates regarding policy coverage verification. The core of the challenge lies in the potential for a claims handler to inadvertently extend coverage beyond what is contractually agreed upon in the policy, leading to financial exposure for the insurer and potential regulatory scrutiny. Careful judgment is required to ensure that all claims are processed in strict accordance with the policy terms and conditions, as well as applicable insurance laws and regulations. The correct approach involves a thorough verification of the policy's coverage provision against the details of the loss before authorizing payment. This ensures that the insurer is only paying for claims that are legitimately covered under the commercial auto policy. This approach is right because it directly aligns with the fundamental principles of insurance underwriting and claims handling, which are heavily regulated. Specifically, it upholds the insurer's obligation to act in good faith and fair dealing, which includes accurately applying policy terms and conditions. Failure to do so could be construed as misrepresentation or unfair claims settlement practices, leading to regulatory penalties and reputational damage. An incorrect approach would be to authorize payment based solely on the claims handler's assumption that the loss is covered, without independently verifying the policy details. This is professionally unacceptable because it bypasses a critical control point designed to prevent coverage errors. It exposes the insurer to financial risk for claims that may not be covered and could lead to allegations of unfair claims practices if the insurer later attempts to deny coverage based on policy exclusions or limitations that were overlooked. Another incorrect approach would be to prioritize speed of payment over accuracy of coverage verification. While prompt claims handling is important, it must not come at the expense of regulatory compliance and sound business practice. Expediting a payment without confirming coverage can lead to significant financial losses and regulatory sanctions for paying claims that are not covered. The professional decision-making process for similar situations should involve a clear understanding of the policy contract and the relevant regulatory framework. When faced with a claim, the professional should first identify the specific policy in question, and then meticulously review its declarations page, policy form, endorsements, and exclusions. Simultaneously, they must consider any applicable state or federal insurance laws and regulations that govern claims handling and coverage interpretation. If there is any ambiguity or uncertainty regarding coverage, the professional should consult with underwriting or legal counsel before authorizing payment. This systematic approach ensures that all decisions are grounded in policy terms and regulatory requirements, thereby mitigating risk and upholding professional standards. Question 13. Governance review demonstrates that a client, a large financial institution, is seeking to develop a new insurance-linked investment product. The proposed structure appears to leverage certain regulatory loopholes to offer a higher yield than typically available for comparable risk profiles, potentially attracting unsophisticated investors. As a certified insurance operations professional (CIOP), you are tasked with assessing the operational feasibility and regulatory compliance of this product. You have identified significant concerns that the product's design, while technically within the letter of some regulations, may violate the spirit of consumer protection laws and could be viewed as an attempt to circumvent established market conduct rules. What is the most appropriate course of action? Option A. Advise the client that the product structure raises significant regulatory concerns regarding consumer protection and market integrity, and recommend exploring alternative, compliant product designs, potentially seeking regulatory guidance on the proposed structure. Option B. Discreetly suggest minor modifications to the product's presentation to emphasize its unique features, without fundamentally altering the structure, to mitigate potential regulatory scrutiny. Option C. Inform the client that the product is too complex and risky to operate within the current regulatory environment and decline to be involved in its development. Option D. Proceed with the product development as planned, assuming the client's legal counsel has deemed it compliant, and focus solely on the operational aspects of implementation. The correct answer is A. Advise the client that the product structure raises significant regulatory concerns regarding consumer protection and market integrity, and recommend exploring alternative, compliant product designs, potentially seeking regulatory guidance on the proposed structure. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial interests of a client with the long-term integrity of the insurance market and adherence to regulatory principles. The CIOP designation implies a commitment to ethical conduct and operational excellence within the insurance industry, necessitating a decision that upholds these standards. The correct approach involves prioritizing transparency and adherence to the spirit and letter of the regulatory framework. This means clearly communicating the limitations and potential risks associated with the proposed product structure to the client, even if it means potentially losing their business. This approach aligns with the core principles of fair dealing, consumer protection, and market integrity, which are fundamental to the regulatory environment governing insurance operations. Specifically, it upholds the regulatory expectation that insurance products are not designed to circumvent established rules or create undue risk for consumers or the broader market. An incorrect approach would be to proceed with the product development as requested without raising concerns or seeking clarification from the regulator. This failure stems from a disregard for regulatory intent and a potential violation of rules designed to prevent market manipulation or the offering of products that are not in the best interest of consumers. Another incorrect approach would be to attempt to subtly alter the product's features to appear compliant while still achieving the client's original, potentially problematic, objective. This constitutes a form of regulatory arbitrage and demonstrates a lack of integrity, undermining the trust placed in insurance professionals and the regulatory system. A third incorrect approach would be to dismiss the client's request outright without exploring potential compliant alternatives or seeking regulatory guidance. While well-intentioned, this can be perceived as unhelpful and may miss opportunities to innovate within the regulatory boundaries. Professionals should approach such situations by first thoroughly understanding the client's objective and the proposed product structure. They should then consult the relevant regulatory framework, including any guidance or interpretations issued by the governing body. If there is ambiguity or a potential for non-compliance, the professional should proactively engage with the client to explain the regulatory concerns and explore alternative, compliant solutions. If necessary, seeking clarification or an opinion from the regulator is a prudent step to ensure both compliance and ethical conduct. Question 14. Governance review demonstrates that the Casualty Insurance Division is experiencing significant delays in claims processing, leading to increased policyholder dissatisfaction and potential regulatory scrutiny. The operations manager proposes implementing a new, highly automated claims handling system designed to drastically reduce processing times. However, the proposed system has limited human oversight for coverage verification and settlement authority is primarily delegated to automated algorithms based on historical data. Which of the following approaches best addresses the operational challenges while adhering to regulatory requirements and ethical obligations for casualty insurance operations? Option A. Delay the implementation of any new system and focus on hiring more claims adjusters to manually process existing claims, as this ensures thorough human review for every claim. Option B. Implement the new automated claims handling system with a phased rollout, ensuring that human claims adjusters are retained for complex claims and for reviewing automated decisions on a sample basis, with clear escalation paths for policyholder disputes and ongoing training on regulatory compliance for all staff involved. Option C. Immediately implement the new automated claims handling system across all claims, as the primary goal is to reduce processing times and operational costs, trusting the algorithm's efficiency to manage claims effectively. Option D. Outsource a significant portion of the claims processing to a third-party vendor that specializes in high-volume, low-cost claims handling, with minimal oversight from the internal operations team. The correct answer is B. Implement the new automated claims handling system with a phased rollout, ensuring that human claims adjusters are retained for complex claims and for reviewing automated decisions on a sample basis, with clear escalation paths for policyholder disputes and ongoing training on regulatory compliance for all staff involved. Explanation: this scenario is professionally challenging because it requires the operations professional to balance the need for efficient claims processing with the absolute imperative of regulatory compliance and fair treatment of policyholders. The pressure to reduce operational costs can create a temptation to streamline processes in ways that might inadvertently compromise policyholder rights or violate regulatory mandates. Careful judgment is required to ensure that cost-saving measures do not lead to regulatory breaches or ethical lapses. The correct approach involves a thorough understanding of the specific casualty insurance regulations governing the jurisdiction, which in this case are assumed to be U.S. federal and state-specific regulations relevant to the Certified Insurance Operations Professional (CIOP) designation. This approach prioritizes adherence to all applicable laws and guidelines, ensuring that claims are handled promptly, fairly, and in accordance with policy terms and regulatory requirements. Specifically, it means implementing internal controls and training programs that equip claims adjusters with the knowledge and authority to make accurate coverage determinations and settlement offers, while also providing clear avenues for policyholder appeals and dispute resolution. The regulatory justification stems from statutes like the Unfair Claims Settlement Practices Act (UXPA) at the state level, which prohibit misrepresentation of policy provisions, failure to acknowledge and act reasonably promptly upon communications with respect to claims, and the failure to adopt and implement reasonable standards for the prompt investigation of claims. Ethically, it aligns with the principle of acting in the best interest of the policyholder while upholding the integrity of the insurance contract. An incorrect approach that focuses solely on reducing claims processing time without adequate consideration for coverage accuracy or regulatory compliance would be professionally unacceptable. This could lead to underpayments, delayed settlements, or outright denials of valid claims, violating the UXPA and potentially leading to regulatory sanctions, fines, and reputational damage. Another incorrect approach, which involves delegating final coverage decisions to junior staff without sufficient oversight or training, risks inconsistent application of policy terms and regulatory requirements, increasing the likelihood of errors and disputes. This failure to ensure competent claims handling directly contravenes the regulatory expectation of prompt and fair claims resolution. A third incorrect approach, which prioritizes cost reduction by limiting the scope of investigations or the use of independent adjusters, could result in incomplete assessments of claim validity and value, leading to unfair outcomes for policyholders and potential regulatory scrutiny for failing to conduct thorough investigations as mandated by regulations. Professional decision-making in such situations requires a proactive approach to regulatory understanding, robust internal controls, continuous staff training, and a commitment to ethical conduct. Operations professionals must regularly review and update their processes to align with evolving regulatory landscapes and industry best practices. They should foster a culture where compliance and policyholder fairness are paramount, even when faced with cost pressures. When evaluating process changes, a risk-based assessment should be conducted, identifying potential compliance gaps and implementing mitigation strategies before implementation. Question 15. The efficiency study reveals that a new automated system can significantly reduce the time taken to process new policy applications by directly accessing and cross-referencing customer health records from external providers. This process would involve the system automatically retrieving and analyzing this sensitive health data without explicit, granular consent for each specific data point accessed during the onboarding process. Which of the following approaches best aligns with the regulatory framework and ethical obligations for a certified insurance operations professional (CIOP) in this scenario? Option A. Halt the implementation of the automated system and revert to the manual process until a comprehensive data privacy impact assessment can be conducted and appropriate consent mechanisms and data minimization strategies are developed and implemented. Option B. Modify the automated system to only retrieve anonymized health data, assuming that anonymized data falls outside the scope of strict privacy regulations and therefore requires no further compliance checks. Option C. Proceed with the automated system, but implement additional employee training on data handling best practices, believing that well-trained staff will mitigate any potential privacy risks associated with the system's data access. Option D. Implement the automated system as proposed, assuming that the efficiency gains and the implicit consent provided during the initial application submission are sufficient to cover the automated retrieval and analysis of detailed health records. The correct answer is D. Implement the automated system as proposed, assuming that the efficiency gains and the implicit consent provided during the initial application submission are sufficient to cover the automated retrieval and analysis of detailed health records. Explanation: the efficiency study reveals a potential shortcut in data handling that could streamline customer onboarding. However, this shortcut involves accessing and processing customer health information, which is protected under specific privacy regulations relevant to the Certified Insurance Operations Professional CIOP exam. The professional challenge lies in balancing operational efficiency with the stringent legal and ethical obligations to protect sensitive personal health information. Failure to adhere to these regulations can result in severe penalties, reputational damage, and loss of customer trust. Careful judgment is required to ensure that any efficiency gains do not compromise data privacy. The correct approach involves a thorough review of the proposed data handling process against the applicable privacy regulations. This includes identifying the specific types of health information involved, understanding the consent requirements for its processing, and ensuring that appropriate security safeguards are in place. The organization must also consider the principle of data minimization, processing only the data that is strictly necessary for the stated purpose. This approach is correct because it prioritizes compliance with privacy laws, which is a fundamental ethical and legal responsibility for insurance operations professionals. It demonstrates a commitment to protecting customer data, a core tenet of professional conduct in the insurance industry. An incorrect approach would be to implement the efficiency measure without a comprehensive privacy impact assessment. This failure to proactively identify and mitigate privacy risks is a direct violation of regulatory requirements that mandate such assessments for processing sensitive data. Another incorrect approach would be to assume that anonymized data is exempt from all privacy considerations. While anonymization can reduce risk, regulations often still apply to the process of anonymization itself and the potential for re-identification, especially when dealing with health information. A third incorrect approach would be to rely solely on employee training without implementing technical and organizational safeguards. While training is important, it is not a substitute for robust security measures and clear policies that govern data access and processing. Professionals should employ a decision-making framework that begins with identifying all applicable regulatory requirements. This is followed by a risk assessment, specifically focusing on privacy and data security. Next, they should evaluate potential solutions against these requirements and risks, prioritizing compliance and ethical considerations. Finally, they must document their decision-making process and ensure ongoing monitoring and adherence to established policies and regulations. Question 16. Benchmark analysis indicates that a significant portion of applicants for a new health insurance product exhibit a higher-than-average propensity to utilize medical services. To mitigate the financial impact of this adverse selection, which of the following operational strategies would be most compliant with regulatory expectations for fair and actuarially sound underwriting? Option A. Develop underwriting guidelines that utilize objective, actuarially validated risk factors such as age, family medical history, where permissible, and lifestyle indicators, e.g., smoking status, to adjust premiums and coverage terms. Option B. Exclude coverage for all pre-existing conditions for the first 2 years of policy enrollment to reduce immediate claims exposure. Option C. Offer a standardized policy with a single premium for all applicants, regardless of their disclosed health status or medical history, to ensure equitable access. Option D. Implement a tiered pricing structure that assigns higher premiums to applicants who disclose pre-existing conditions, with the tiers determined by the severity and type of condition, as assessed by a medical review board. The correct answer is D. Implement a tiered pricing structure that assigns higher premiums to applicants who disclose pre-existing conditions, with the tiers determined by the severity and type of condition as assessed by a medical review board. Explanation: this scenario is professionally challenging because it requires an insurance operations professional to balance the need for efficient underwriting and risk assessment with the ethical and regulatory imperative to avoid discriminatory practices. Adverse selection, where individuals with higher risks are more likely to seek insurance, can destabilize the insurance market if not managed appropriately. However, the methods used to mitigate adverse selection must not violate principles of fairness and non-discrimination, which are foundational to insurance regulation. Careful judgment is required to identify and implement strategies that are both effective in managing risk and compliant with regulatory frameworks. The correct approach involves implementing underwriting guidelines that are based on objective, actuarially sound risk factors and are applied consistently to all applicants. This approach directly addresses adverse selection by allowing insurers to price policies appropriately based on the assessed risk of the applicant pool. It is justified by regulatory frameworks that permit insurers to underwrite risks but prohibit unfair discrimination. For example, regulations typically require that underwriting criteria be demonstrably related to the risk of loss and not based on protected characteristics. This ensures that premiums reflect the actual risk, maintaining the solvency of the insurer and the fairness of the insurance market. An incorrect approach would be to use broad, unsubstantiated assumptions about certain demographic groups to deny coverage or charge significantly higher premiums. This is ethically problematic, as it can lead to unfair discrimination against individuals who may not actually pose a higher risk. From a regulatory standpoint, such practices often violate laws prohibiting unfair discrimination in insurance, as the criteria used are not actuarially justified and may be based on stereotypes rather than individual risk assessment. Another incorrect approach would be to ignore the potential for adverse selection altogether and offer policies without any underwriting. While this might seem inclusive, it can lead to a pool of insureds with a disproportionately high number of high-risk individuals. This can result in unsustainable premium levels, financial instability for the insurer, and ultimately, a market where insurance becomes unaffordable or unavailable for many. This approach fails to meet the regulatory obligation of prudent risk management and can jeopardize the insurer's ability to fulfill its contractual obligations. A third incorrect approach would be to implement a one-size-fits-all pricing strategy that does not differentiate based on risk. This fails to address adverse selection effectively. While it might avoid some forms of discrimination, it can lead to lower-risk individuals subsidizing higher-risk individuals, potentially driving lower-risk individuals out of the market and creating an adverse selection spiral. This is not aligned with the principles of actuarial soundness and fair pricing that underpin insurance regulation. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory framework, including prohibitions against unfair discrimination and requirements for actuarial justification of underwriting practices. Professionals should consult with underwriting and actuarial departments to ensure that any proposed strategies for managing adverse selection are based on sound data and are applied consistently. Ethical considerations, such as fairness and equity, should be paramount. When in doubt, seeking legal counsel or guidance from regulatory bodies is advisable to ensure compliance and uphold professional standards. Question 17. Strategic planning requires insurers to accurately assess and classify risks to ensure appropriate policy placement and regulatory compliance. When considering coverage for a client's valuable equipment that is primarily used at a fixed business location, but is occasionally transported to different job sites, which of the following approaches best aligns with sound underwriting principles and regulatory expectations for inland marine insurance? Option A. Classify the equipment under an inland marine policy based solely on the client's request, regardless of the property's inherent mobility or primary use. Option B. Classify the equipment under a standard commercial property policy, as its primary use is at a fixed business location and any transportation is incidental. Option C. Classify the equipment under an inland marine policy that specifically covers property in transit or of a type commonly transported, provided the primary risk is associated with its mobility and occasional transport to various locations. Option D. Classify the equipment under a general liability policy, as the risk of damage during transport is a liability concern. The correct answer is C. Classify the equipment under an inland marine policy that specifically covers property in transit or of a type commonly transported, provided the primary risk is associated with its mobility and occasional transport to various locations. Explanation: this scenario is professionally challenging because it requires a deep understanding of the nuances of inland marine insurance, specifically distinguishing between property that is inherently mobile and property that is incidental to a fixed location. Misclassification can lead to significant coverage gaps, regulatory scrutiny, and financial losses for both the insurer and the insured. Careful judgment is required to ensure that policy provisions align with the actual risk being insured and comply with regulatory expectations for accurate underwriting and claims handling. The correct approach involves accurately classifying the insured property based on its inherent mobility and the nature of the risk. Inland marine insurance is designed for property that is in transit or is of a type that is commonly transported. Property that is permanently affixed to a building or is primarily associated with a fixed location typically falls under a standard property policy. This distinction is crucial for proper risk assessment, premium calculation, and ensuring that the policy provides the intended coverage. Regulatory frameworks, such as those overseen by state insurance departments in the U.S., mandate that insurers underwrite risks accurately and provide clear, understandable policy language. Misrepresenting the nature of the risk or the scope of coverage to fit it into an inland marine policy when it belongs elsewhere would be a violation of these principles. An incorrect approach that misclassifies property permanently installed at a business location, as inland marine insurance fails to adhere to the fundamental principles of risk classification. This leads to regulatory noncompliance because it misrepresents the risk to the insurer's underwriting and reserving functions, potentially violating solvency requirements. It also creates an ethical failure by providing coverage that is not designed for the risk, potentially leaving the insured exposed to claims that are not covered, or, conversely, charging premiums that are not commensurate with the actual risk profile. Another incorrect approach that attempts to cover property that is not typically associated with transit or mobility under an inland marine policy, simply because it is a valuable asset, ignores the established categories of insurance. This is a regulatory failure as it circumvents the intended purpose of different policy types, leading to inaccurate statistical reporting and potentially impacting rate filings. Ethically, it is a disservice to the insured by offering a policy that may not respond as expected in a claim situation. A third incorrect approach that relies solely on the insured's request to place coverage under an inland marine policy without independent underwriting review is also professionally unacceptable. This bypasses the insurer's responsibility to assess and underwrite risks appropriately, which is a core regulatory requirement. It also represents an ethical lapse, as the insurer has a duty to provide appropriate coverage, not just what the client asks for, if that request is based on a misunderstanding of insurance principles. The professional decision-making process for similar situations should involve a thorough review of the insured property's characteristics, its typical location, and its susceptibility to risks associated with transit or mobility. This requires consulting underwriting guidelines, policy forms, and relevant regulatory interpretations. When in doubt, seeking clarification from underwriting specialists or legal counsel is essential to ensure compliance and ethical practice. The focus must always be on accurately matching the risk to the appropriate insurance product. Question 18. Process analysis reveals that the current fraud detection system relies heavily on manual review of all claims exceeding a certain monetary threshold, leading to significant delays and a high rate of missed fraudulent claims that fall below this threshold. Considering the regulatory framework for insurance operations, which of the following implementation strategies would best enhance fraud detection and prevention while maintaining operational efficiency and customer satisfaction? Option A. Introduce a mandatory, comprehensive background check for all policyholders and claimants, regardless of transaction value, to proactively identify potential fraudsters. Option B. Increase the monetary threshold for manual review significantly to expedite the processing of most claims, assuming that larger claims are more likely to be fraudulent. Option C. Shift to a purely automated system that flags any transaction deviating from a predefined normal pattern, with no provision for human intervention or appeal. Option D. Implement a hybrid system combining advanced data analytics for anomaly detection across all transactions with a tiered rule-based system, supported by targeted human review of high-risk flagged cases. The correct answer is D. Implement a hybrid system combining advanced data analytics for anomaly detection across all transactions with a tiered rule-based system, supported by targeted human review of high-risk flagged cases. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient fraud detection with the imperative to comply with regulatory requirements and maintain customer trust. The Certified Insurance Operations Professional (CIOP) must implement a fraud detection system that is not only technologically sound, but also ethically and legally defensible within the specified regulatory framework. The challenge lies in selecting an approach that maximizes detection efficacy without creating undue customer burden or violating privacy principles, all while adhering to the strict guidelines governing insurance operations. The correct approach involves a multi-layered strategy that leverages data analytics for anomaly detection, incorporates rule-based systems for known fraud patterns, and includes a human review process for flagged cases. This is the most professionally sound because it aligns with the principles of responsible data handling and regulatory compliance. Specifically, it addresses the need for proactive fraud prevention by identifying suspicious activities early. The data analytics component allows for the detection of novel or complex fraud schemes that might evade simpler rule-based systems. The inclusion of human review ensures that legitimate transactions are not erroneously flagged, thereby minimizing customer inconvenience and potential reputational damage. This approach is ethically sound as it aims to protect both the insurer and its customers from financial harm caused by fraud, and it is compliant with regulations that mandate robust internal controls and risk management practices for fraud prevention. An incorrect approach would be to solely rely on a broad, high-threshold rule-based system without any data analytics or human oversight. This is professionally unacceptable because while it might catch some obvious fraud, it would likely generate a high number of false positives, leading to significant customer dissatisfaction and operational inefficiency. Ethically, it fails to adequately protect legitimate customers from the disruption caused by overzealous automated flagging. From a regulatory perspective, it may not demonstrate the reasonable steps required to prevent fraud, potentially leaving the insurer vulnerable to penalties. Another incorrect approach would be to implement a system that heavily relies on intrusive customer data collection beyond what is strictly necessary for underwriting and claims processing, without clear consent or justification. This is professionally problematic as it infringes on customer privacy, potentially violating data protection regulations and eroding trust. Ethically, it is questionable to collect and analyze sensitive personal information without a direct and justifiable link to fraud prevention for that specific customer's transaction. A third incorrect approach would be to implement a system that is entirely reactive, only investigating potential fraud after a claim has been paid or a policy has been issued and a complaint is received. This is professionally deficient because it fails to meet the proactive fraud prevention expectations of regulators and industry best practices. It is also ethically unsound as it allows fraudulent activities to succeed, leading to increased costs for honest policyholders and a less secure insurance market. Professionals should adopt a decision-making framework that prioritizes a risk-based approach. This involves understanding the specific fraud risks relevant to the insurance products and operations, assessing the potential impact of fraud, and then selecting and implementing detection and prevention measures that are proportionate to those risks. This framework should also incorporate continuous monitoring and evaluation of the system's effectiveness, ensuring ongoing compliance with evolving regulations and emerging fraud typologies. A commitment to transparency with customers regarding data usage and fraud prevention efforts is also crucial. Question 19. Risk assessment procedures indicate that a new automated system for initial claims assessment could significantly reduce processing times and operational costs. However, concerns have been raised about its ability to accurately interpret complex policy clauses and the potential for it to overlook specific circumstances that might warrant a deviation from standard assessment. What is the most appropriate approach for the certified insurance operations professional to recommend regarding the implementation of this automated system? Option A. Defer the implementation of the automated system indefinitely due to the potential for errors, prioritizing existing manual processes to maintain the highest level of accuracy and adherence to policy terms. Option B. Implement the automated system immediately to realize cost savings and efficiency gains, with a plan to address any identified issues retrospectively. Option C. Conduct a comprehensive pilot program of the automated system on a subset of claims, rigorously validating its accuracy against underwriting guidelines and regulatory requirements for claims handling, and establishing clear protocols for human review of complex or flagged cases before full rollout. Option D. Proceed with the implementation of the automated system, focusing solely on its speed and cost reduction capabilities, and train customer service representatives to handle policyholder complaints arising from any assessment inaccuracies. The correct answer is B. Implement the automated system immediately to realize cost savings and efficiency gains, with a plan to address any identified issues retrospectively. Explanation: this scenario is professionally challenging because it requires balancing the need for efficient claims processing with the fundamental insurance principle of utmost good faith and the regulatory obligation to ensure fair treatment of policyholders. The CIOP professional must navigate the potential for process optimization to inadvertently compromise these core tenets. The correct approach involves a thorough review of the proposed automated claims assessment tool against established underwriting guidelines and regulatory requirements for claims handling. This ensures that the automation does not introduce bias, overlook critical policy conditions, or lead to unfair claim denials. Specifically, it aligns with the regulatory framework's emphasis on fair claims settlement practices, which mandate that insurers act in good faith and handle claims promptly and equitably. By validating the tool against these principles, the CIOP professional upholds the insurer's duty to the policyholder and avoids potential regulatory sanctions for unfair claims practices, an incorrect approach that relies solely on speed and cost reduction without adequate validation risks violating the principle of utmost good faith. This principle requires both the insurer and the insured to be honest and transparent. If the automated tool is not rigorously tested for accuracy and fairness, it could lead to the insurer acting in bad faith by unfairly denying or underpaying claims, thereby breaching regulatory requirements for fair claims handling. Another incorrect approach that prioritizes the reduction of manual intervention above all else, without considering the potential for errors or the need for human oversight in complex cases, is also professionally unacceptable. This overlooks the fact that insurance contracts are complex and that some claims may require nuanced interpretation that an automated system might not be equipped to handle. This can lead to regulatory breaches related to the proper investigation and assessment of claims. Finally, an approach that implements the automation without consulting with underwriting and claims departments, or without considering the impact on customer service, fails to adopt a holistic and compliant process optimization strategy. This demonstrates a lack of understanding of the interconnectedness of insurance operations and the importance of adhering to established operational procedures and regulatory mandates that govern claims handling and customer interaction. Professionals should employ a decision-making framework that begins with identifying the core objective, process optimization. This must then be immediately followed by an assessment of potential impacts on key insurance principles, utmost good faith, indemnity, and regulatory obligations, fair claims handling, consumer protection. Any proposed optimization must be rigorously tested for compliance and fairness, with clear escalation paths for complex or ambiguous cases. Collaboration with relevant departments and ongoing monitoring of outcomes are crucial for sustainable and compliant process improvements. Question 20. Governance review demonstrates that a life insurer is proposing a significant upgrade to its policy administration system. This upgrade is anticipated to streamline several back-office processes, leading to substantial cost savings and improved operational efficiency. However, the proposed system change may alter the way certain policyholder data is displayed and accessed, potentially impacting the clarity of information for policyholders who have historically relied on specific legacy reporting formats. The CIOP is tasked with assessing the operational implications of this change. Which of the following approaches best aligns with the regulatory framework and professional obligations for a CIOP in this situation? Option A. Implement the system upgrade immediately to realize the anticipated cost savings and then conduct a post-implementation review to identify any policyholder issues that may have occurred. Option B. Delegate the responsibility for assessing policyholder impact to the IT department, focusing solely on the technical aspects of the system migration and operational efficiency gains. Option C. Prioritize the cost savings and operational efficiencies identified by the system upgrade, proceeding with implementation and addressing any policyholder concerns or complaints on an ad hoc basis as they arise. Option D. Conduct a thorough impact assessment to identify potential adverse effects on policyholders, particularly those who may be less digitally savvy or accustomed to legacy reporting, and develop mitigation strategies to ensure continued clarity and accessibility of policy information before system implementation. The correct answer is D. Conduct a thorough impact assessment to identify potential adverse effects on policyholders, particularly those who may be less digitally savvy or accustomed to legacy reporting, and develop mitigation strategies to ensure continued clarity and accessibility of policy information before system implementation. Explanation: this scenario presents a professional challenge because it requires the Certified Insurance Operations Professional (CIOP) to balance the need for efficient operational processes with the paramount regulatory obligation to protect policyholder interests and ensure fair treatment. The CIOP must exercise careful judgment in assessing the impact of a proposed system change on a vulnerable customer segment, ensuring that operational efficiency does not come at the expense of regulatory compliance and ethical conduct. The correct approach involves proactively identifying and mitigating potential negative impacts on policyholders before implementing the system change. This aligns with the core principles of the regulatory framework for insurance operations, which emphasizes customer protection, fair treatment, and the prevention of adverse outcomes. Specifically, it reflects the regulatory expectation that insurers conduct thorough impact assessments, particularly for changes that could affect policy administration, claims handling, or customer communications, and to put in place appropriate safeguards. This approach demonstrates a commitment to regulatory compliance by anticipating and addressing potential breaches of customer protection rules before they occur. An incorrect approach that focuses solely on the cost savings and operational efficiency of the system change, without adequately considering the potential impact on policyholders, represents a significant regulatory and ethical failure. This demonstrates a disregard for the insurer's duty of care towards its customers, and a failure to adhere to the principles of fair treatment and good conduct expected under the regulatory framework. Such an approach could lead to breaches of regulations concerning customer vulnerability, data privacy, or the accuracy of information provided to policyholders. Another incorrect approach that involves proceeding with the system change and addressing any policyholder complaints or issues on a reactive basis is also professionally unacceptable. This reactive stance fails to meet the proactive obligations imposed by the regulatory framework, which expects insurers to anticipate and mitigate risks to policyholders. It also risks reputational damage and potential regulatory sanctions for failing to adequately manage operational changes and their consequences. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should mandate a comprehensive impact analysis that considers all stakeholders, with a particular focus on vulnerable customer segments. It should require the identification of potential risks, the development of mitigation strategies, and the establishment of clear escalation paths for any identified issues. Furthermore, it should embed a culture of continuous monitoring and review to ensure that operational changes do not inadvertently compromise regulatory compliance or policyholder well-being.